The Treasury sell-off, leaving many investors feeling the pain. Jared Blikre is here on the floor of the New York Stock Exchange with a closer look at what that pain looks like. Jared?
Oh, Julie, it's so painful. We're in a 3-year Treasury drawdown. This has only happened twice before in the last 100 years. You'd have to go back to the 78 to 80 era, and you would see, okay, we had a 3-year drawdown, then 32 to 33, somewhere in the midst of the Great Depression, and now that's currently what we're facing. But I want to go to the Wi-Fi Interactive and just kind of chart what's happening today in the 10-year. You're going to note that in the daily and 52-week range, we have a high of 5.00%. So that's the first time we've reached that level since 2007. And if I pull up a chart here, this is a year to date. You can see here the 3.25 lows in March. That was in the midst of that internet banking panic. And then it's been off to the races, and we've even accelerated towards the upside here. So a lot of people saying this looks like a parabolic move, which has all kinds of implications. I think it's a little bit early for that, but I want to show you, this is a 10-year Treasury yield chart from 1965 to 2023. And Julie, you might remember the pink dots chart from the other day. Well, this is a little variation of it. If you take the number of times that the 10-year yield has surged more than 10 basis points in one day, you do that for each month and you add it up, all the way at the right-hand side, you're going to see, well, currently we have 4 of those events this month, and 1 of those is to the downside. What I want to show, and just a general impression from this chart though, is to show that this era that we're in right here is really a low era of low volatility in treasuries. We have seen some much greater volatility, especially in the late 70s and the early 80s. So all of this to say is there's a lot more volatility that could come if we get a surge in interest rates above 5%, and that's that big psychological mark. Does that really matter? Well, yes, because anytime we get a surge in rate with bond volatility, that spills over and it doesn't leave much room for other risk assets. I want to show you another chart on the Wi-Fi Interactive. This is a NASDAQ 100 going back to 1999 divided by US Treasury. So this is the tech to Treasury ratio. As high as it was in the dot-com bubble, around 5 there, it is much higher nowadays in the current epoch, and that is because not only is the NASDAQ 100 surging because of the mega caps that are outperforming, but also concurrently we have Treasury bonds underperforming, and in fact in that 3-year downdraft. You put it together with everything Powell said today, there's just increased uncertainty in the market, and Powell himself doesn't think that this latest rise is due to anything endemic of our future expectations of interest rates. So he might be on pause, but he might have to catch up later, or maybe he's done too much already. We just don't know, Julie.
Jared Blikre, I'll take it from here. Thank you, Jared.
All right, thank you.